Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is part of that effort. And we've been at this podcast for a few years, and I've had a bunch of amazing conversations and have learned a lot from the guests who have been on. After a couple years of doing this, we have decided to try something a little new. While we'll still be talking to guests, we're going to try to unearth some of the internal conversations we have at Interplay and share them with the public. I get a lot of my best news and insights from the team at Interplay. They're super sharp. They're all having lots of conversations themselves, synthesizing it, and sharing it internally. And so we've decided to create a new format that we call the Partner Meeting. Today's going to be the first Partner Meeting episode. And in this segment, I'm going to have quick one-on-one chats with 4 of the different partners at Interplay. Now, we have a bigger team, but these are the 4 who are joining in to share topics that they cover. We have Mike Rogers, partner over on the venture capital side, who will come in and chat about the VC and startup marketplaces. Chris Zhang, on our family office, is going to cover global and macro trends, which makes a ton of sense given he, for 10 years, was a trader at Morgan Stanley, trading derivatives, fixed income, and other things I probably can't even spell. We got Brett Palatiello, partner over on our blockchain side of the house, and he's going to fill us in the latest and greatest happening in blockchain, crypto, and Web3. And Fong Ireland, who is living on the front lines of operations as the partner over on the incubator side of Interplay, is going to share a business tip of the week. So without any more delay, welcome to the Partner Meeting. Let's jump in. First up, we have Mike Rogers diving in to VC and startup market trends. All right, Mike, what do you have for us this week?
Yeah, well, the venture market's been interesting, to say the least, this September. So I think a lot of VCs after the summer break thought that coming back in September, deals would start to pick up maybe quite ferociously. And the truth of the matter is we really haven't seen that yet. We are starting to see, at the Series A at least, the market unstick a little bit. People poking their heads back out to take temperature, figure out what interest is on the investor side, what pricing looks like, et cetera. But we really haven't seen the deal pickup that we thought we would. And I think what that really bodes to is just a mismatch in the market between what the expectations are for founders and what the expectations are for VCs in terms of price of the round. And we just haven't seen equilibrium yet. And because of that, I think, again, VCs have an expectation that things are going to price much lower, given public market comps, investor sentiment, overall macroeconomic feelings and headwinds. And investors still think their company is worth what it might have been worth 6 or 12 months ago. I think that might not be completely true. I know they don't think it's worth exactly what it was at the peak of the market, but they don't think it's worth what people are trying to price it at today. And, we'll see. I think a lot of people are saying, oh, well, there's so much dry powder out there in the market. Yeah, that's true. There's a lot of dry powder out there, but at the end of the day, VCs don't have to deploy capital every day, every month, every week. Entrepreneurs will need to raise money at some point. And we'll see how that shakes out over what I think will really be the next 3 to 6 months.
What's interesting is I talk to a lot of my buddies in private equity, and they say, look, there's a bid-ask spread issue right now. Deals are not getting done. Yeah. But they live in a world where companies are generally cash flow positive. They can just sell in 2 years, 3 years. They can wait this out. Venture is not the same. We intentionally run companies that could be profitable at a loss to optimize for growth. And so there's a lot of companies out there that aren't able to retool for profitability, and there's only so long they can hold their breath before they have to come up for air and raise money. So, it's interesting. I thought we were actually going to be seeing more transaction volume, more deal flow popping up already, just because no one knew this was coming. It was impossible to budget properly. Now, that said, deals are getting done. We've made some investments recently, but it's not back to the normal cadence that we saw pre-dip.
Yeah, agreed. And I think if you look at what's going on in the public markets as well right now, the NASDAQ hit another low again this week. We're talking Friday, September 30th. And people are spooked. You've got sentiment ratcheting up in overseas in Europe right now. I think that's definitely scaring some investors. Obviously, inflation is not quelled at all. So on our side, I think people want to see that turning the corner before they start to write big checks. Now, again, at the seed, maybe even the Series A level, people are really looking 3, 4, 5, 6, 7, maybe 10 years out. So can you still make bets at that stage? Absolutely. B, C, D, not sure, right? How do you know how to price a company fairly? How do you know what the thing might look like? What does an exit look like? When? All these things that you try to pinpoint as an investor become really hard to do in a market like this.
Yeah, I mean, the valuations we're seeing and the deals we're doing on the early stage, they're down from where they were last year, but they're kind of more like at 19 levels. The carnage we're seeing at the growth stage, where there's a shorter time horizon to exit. Early stage, we're buying now for a far off market exit.
Yeah, exactly.
Right. The carnage there is a lot different, a lot heavier, and it's a tougher time to be a founder of a more mature company.
Yeah, and the growth stage math is really pretty simple if you think about it. It's if a company raised a large growth round last year, and let's say it was a SaaS business, and maybe they priced it at 30 or 40 times revenue, those market comps are now 10 or 15 times revenue, right? For a high growth business. So for that company, they would have had to triple revenue between that raise and this raise, even to get back to the same valuation on a relevant multiple. And that's just not happening, especially as the economy slows down, as people are cutting headcount, as sales growth has slowed down. And we're seeing it across pipelines for SaaS companies and for consumer businesses too. So while I think the economic shock hasn't been quite as strong yet, and you saw that in the consumer spending data this week, people are still spending a lot of money. Companies are bracing for impact, and that is slowing sales down sort of by the natural effect.
Mike, this is great. Thanks for giving us some insight here. Appreciate you.
My pleasure.
Up next, we have Chris Zhang covering the broader market dynamic. Chris, my dude.
Mark, how are you?
Good, man. What's happening in the market? Give us the update.
It's one of those weeks where every day we're bombarded with headlines, and unfortunately, most of them are not looking great. So, long story short, let's start from the beginning. In the U.S., we had a few data came out. Of course, we've got the perpetual inflation data that this week was the personal consumption expenditure data, which is really the Fed's preferred way of looking at inflation. That came out stronger than expected. We've got the job data, which is, and this week is the initial jobless claims that came out at the lowest level since March 2022. Both data basically give the Fed more reasons to hike at a faster than expected speed, which of course is bad for risky assets. So you've seen this capitulation of the market since the Fed meeting 2 weeks ago of the 75 basis point hike of continued losses in equity market and the rest of the risky assets as well. And in addition to the U.S., of course, the biggest news of the week, arguably, was in England, where after the surprise tax cuts, which are obviously very controversial and have driven the market to the extreme in risk sentiments. Now, Bank of England came out with a surprise intervention, which is a bond buying program similar to the QE program here in the States, where the Bank of England has agreed to buy up to 5 billion sterling a day worth of long-dated gilts, or also known as the Treasury, effectively the Treasury bonds in the UK for 2 weeks straight. So this was intended to stabilize the market, has sent signals that to the rest of the central banks in the world that maybe it's time to begin some sort of easing, which has helped risk sentiment initially for about a day. We saw S&P rally back about 2% from the lows. Treasury rates have stabilized. Gilts, again, the Treasury in the UK sold off 150 basis point almost leading up to it, and then all of a sudden had a single biggest rally of many years, 50 basis point. After all that, only to give back basically all the gains in the market on Thursday, where investors are taking a hard look at the intervention and basically have decided that maybe the scale is not big enough, and the timing is not right, and so what we're seeing is a continued downward trend in risk sentiment. So today we're basically making yesterday and today making new lows in the market again. And I know it's a long-winded answer to your question, but there's one more thing, of course. We cannot talk about what's happening in the world without mentioning at least Russia, where the big news this week is the official votes on the annexations of a few Ukraine territories. That has gone through officially as of today. Again, bad for risk sentiments. This could lead to a dragged on war scenario where Europe will definitely suffer in the winter with the supply chain disruption, energy crisis, and of course the rest of the world will feel that as well.
So the overall headline is, hey, we've been in a tailspin for a while and it's not over.
Unfortunately, yes. As an investor, you of course you don't like uncertainties, and you like there are more certainties in the world. But at the moment, we're just seeing uncertainties in sort of all fronts: geopolitical, economic, domestic, international, you name it. And it's a tough spot to be, and it's hard to see the bright side at the moment.
You are the most pessimistic person in our group, probably with good reason. You're staring at this data, whereas all the private market folks are staring at these rosy stories of companies, building the future. What's the opportunity set here? Is there any silver lining in kind of all of this negativity that people should be thinking about?
Great question. Frankly, as an investor, you want to be the long only type of investor. You want to bet on the rosy future, if you will, and me included. So we're always on a hunt for an upturn in the market. Look, it's all about expectations versus reality. And market is always forward looking. 6 months, 9 months. It's sort of arguable there. So it's a matter of when you think markets overprice the risk and the uncertainties around the globe. If at one point we're starting to see that the market right now is, for instance, pricing in about 4.6% top rates from the Fed in the U.S. If at one point we're starting to see market participants are, in the futures market are starting to price in 5%, 6% interest rates, and our view is that potentially we won't need to get there to bring down inflation. And that's a scenario where, markets overprice the risks, overprice the downside. And that's potentially when we can start to think about adding to our long positions and betting on a better future in risky assets. And of course, whenever, markets are too pessimistic about the world, I think it's always good to come in and think more rationally.
Well, you've brought down my mood for the entire day, but thanks for being here. So everyone knows Chris is a SEC registered RIA, so nothing he said should be considered financial or investment advice, blah, blah, blah. That's my disclaimer. You're probably going to hear it way too often. All right, buddy. Thanks for being here.
Thank you. Have a good one.
All right. Now, Brett's going to come in and cover blockchain. All right, Brett. What's happening in the world of blockchain?
Yeah. So one thing I wanted to bring up, and I've noticed over the past couple of weeks, we're starting to see more high-profile forays into Web3. Starbucks recently announced that they're going to integrate NFTs into their rewards program on Polygon. So that's very interesting because obviously the rewards program is pretty massive. We also saw Warner Music Group, a big record company. They're going to be partnering with OpenSea to allow their artists like Cardi B to more easily access and issue NFTs. There's a few other things. Finally, U.S. Facebook and Instagram users, everybody will be able to display their NFTs on those different social media platforms. Google's head of Web3 said they're looking to be layer 0 for Web3. So it's very interesting to see everybody starting to pile in. And that's a little concerning in the space for some people, considering a lot of this technology is supposed to be disrupting their business models. But it does show that the space is being taken much more seriously. the values of decentralization and interoperability are being taken much more seriously. So it's definitely a hat tip to what we're building here.
Well, here's a question, though. I've been talking to people at large companies for the last couple of years about this, and it doesn't seem like they really had their head around how blockchain, how NFTs really fit into their businesses. They knew it was neat. They knew it was a hot topic. They probably knew they'd get promoted if they did something around it. But the ways they were talking about using it didn't have real practical business applications, and I think they knew that. So are the approaches that you're seeing now thoughtful and reflecting the underlying utility of the technology, or are they kind of like lipstick on a pig? What's happening here?
I think they're definitely starting to figure out that there's real use cases for this stuff. For example, NFTs for rewards programs can be a much more engaging, interactive way to issue a rewards program, and it's all on the blockchain, so it's all interoperable with everybody else's ecosystem, right? They all share the same rails, which is why both Instagram and Facebook you can display your NFTs, right? So you're able to port things from different places, and also it's a shared layer for all of this data to live and move. So they don't need to build out this infrastructure. They can just place it on a public blockchain that's being managed by a decentralized community of validators or nodes.
Right. And so I would imagine a lot of these companies are starting to work with the consultants in the space. For those who don't know that, there's a number of firms that have popped up that are experts in how to work with NFTs and the blockchain, and they're advising large corporations. Are you hearing any engagement on that in the background, or do you know how they've kind of picked up the intel on this?
In terms of consultants?
Yeah, people who are actually helping them. And we've got friends over at a place like Minotaur and other places that do real work and try to help people navigate this.
I mean, a lot of what we're looking for is people that are, and they call it Web 2.5 is one of the themes we're going to be investing in, is bringing all of this technology to the mainstream, right? There's a lot of it's supposed to liberate artists from big record labels. The problem is they don't have the tool sets to be able to use this type of technology or create, NFTs or issue them and create generative art and things like that. So a lot of that's going to require a traditional Web 2 UI UX, which is much nicer than Web 3 UI UXs. But it's also going to be a little bit more white glove. We're going to start seeing probably the larger labels, at least. We're going to have people like Minotaur creating NFT projects for these larger artists. So a lot of the next transition from where we are to the next, say, 100 million users, I think is going to be within or in front of a traditional Web 2 interface, abstracting away all of this technology from users and creators, and instead you just have one more seamless experience, and you're able to do things that you couldn't do before, or you're able to do things in a much more efficient way.
I totally agree on that front. I think when people, from a consumer standpoint, don't know the taglines or the Web3 or the blockchain or NFT, when that's not actually part of the user experience, they're just doing something that they want to do in a mobile app or on a web. I think that's what I think we're going to get mainstream adoption.
Yeah, no, that's exactly what I think it's going to look like. We're just going to be using this technology. You're not going to know which chain you're on. You're not going to worry about moving assets to and from different applications or different chains. So ultimately, again, you're just going to be able to do something cooler that you couldn't do before, or more engaging, right? You have NFTs that evolve, or they allow you to do certain things or access certain people. So I think that's the ultimate end state. And then at a very base layer, we're going to see, much more decentralized things that are more trying to be universally accessible. So people can take their keys and their data from them and go, they call it self-sovereign. And essentially it's a check on power of big corporations who are, abusing data or abusing users. So I think it's a great system overall.
Brett, appreciate you, man. Thanks for the update.
Thank you.
And last but not least, we've got Fong here covering the business tip of the week. Fong, all right. What do you have for us this week?
Hi, everyone. So today I wanted to talk about talent and team building. In the Interplay Incubator, a big part of what we do is we work with companies to ensure that they have the right people in place and the right team structure so that they can really succeed and scale. Now, to create a high performing team, it's absolutely essential that you pull together people with different backgrounds, different skill sets, and different working styles. So, how do you know that you have the right people in place? How do you know if you're missing a key team member? An exercise that we like to do in the incubator, and something that we internally call the Superman analysis. And we call it that because no one can do it all by themselves, right? No one's a Superman. So it's really simple, but it's a great tool to help you uncover the holes in your team. So for those of you watching on YouTube, I'm going to show you an example of what it looks like. And then for people just listening, I'll just follow along. I'm just going to explain it. So here we've come up with, I'm doing the Superman analysis for an econ company. So on the left-hand column, we list out all the skills that you would need for across the entire company for that company to really run efficiently and meet their business objectives. So specifically for this company, it's things like supply chain management, assortment building, 3PL management, tech builds, emails, all the marketing activities. This is probably not exhaustive, but and this will differ between companies and industries. Then on the next few columns, we list out each person on the team. So in this particular case, we have 2 co-founders and 3 employees. Now for each team member, we then go down and put an X next to the skills that they have on each line. So you'll see co-founder 1 is really doing a lot of supply chain management, 3PL management. Co-founder 2 is doing a lot of the kind of Shopify and website management, and then on for the 3 other employees. Now, once you're done with that, it'll become really clear where the holes in your team are. So, for example, in this particular case, customer service seems to be something that co-founder 1 is doing, but he or she is not really, that's not a strength of theirs. That's why I have this, I bold the areas where it's a strength for that person, and then I put in a different color where they're doing the activity, but it's not a strength for them. So it seems like customer service is an opportunity here. Co-founder 1 is doing it. She has a lot on her plate, and it's a really important activity for an ecom company. Partnerships and events seems like another opportunity, content creation and community building, on and on. So as you can see, it's a really illuminating analysis. It tells you visually where the holes on your team are, and if one person is doing too much or too little for that matter, or if someone's working on too many activities that are not a key strength for them. So that's the Superman analysis.
This is a great tool. One of the things that's so powerful about it is, Fong, what you're doing here, I have found that founders will look at this and be like, oh, we basically have 2 activities with this person, 2 activities with that person, 2 activities with this person. And we put it all together, it's actually a full-time job description. And it's not easy to see that you can create jobs out of kind of the little overage that a lot of different people are facing. So this is a really useful tool for it. One other thing I think is really fun with it too, for folks listening, is once you figure out where you currently are, you can make another copy of this document and you can plot out where you want to be. You can say, okay, we're going to move these 3 over to this person. We're going to realign some work internally. We're going to add a couple people to the team. Here's what they're going to be doing. It's so simple. Having the team doing the right types of work is so important. And almost shamefully, we've never experienced another tool to do this. So we kind of came up with this concoction. One of the last things I want to talk about, which I think is fun on this particular topic, Fong, when you look at these roles and how things are allocated, I love thinking about how it's going to evolve as the organization scales. Now, a lot of people are doing the Superman analysis in the early days. They're doing it in their team of 1 to 10. But if you're doing it right, when someone has a 20-person team or a 30-person team, there's a trend here, right? The founders should increasingly move tasks off their plate. So I love that this starts to give insight into what people should be thinking about getting out of their workflow, what they should stop doing and start delegating, which is a constant challenge for folks. And I think being intentional about it is a little easier when you see it.
Yeah, for sure. I mean, I think, as founders and co-founders, it's really a lot of co-founders really have too much on their plates, right? They're doing everything from high level to kind of some more of the day-to-day, I wouldn't want to call it menial tasks, but those are the things that you can start prioritizing to get off of the founder's plate so they can focus on the big activities that are really driving the business. But you can't do it on day one, obviously. It's kind of, over time.
This was awesome. Thank you for sharing this, Fong.
Thank you.
All right, that was our first go at the partner meeting. I thought that was pretty awesome. I don't know if you liked it as much as I did, but I was interested in it. Hopefully it was engaging for you guys. We're trying to come up with fun names for each of the segments for the 4 partners. If you have ideas, please drop them on Twitter or in the chat commentary area. And that's our first go at the partner meeting format. So look, you know the drill. If you want to get in touch, you can find me on Twitter at MPD. And to hear more of my conversations with innovators, you can subscribe on YouTube or any major podcast platform. Just search for Innovation with Mark Peter Davis.